Welcome to The Explainer. I want you to imagine a financial thriller where the stakes aren't just in the millions, but billions. We're talking about a story full of staggering ambition, totally unprecedented successes, and honestly, some spectacular headline-making collapses. To really understand the ultimate modern case study in high-stakes risk and reward, which is the SoftBank Vision Fund, we have to start with its architect, Masayoshi Son. This guy is a true visionary. He made literally one of the greatest bets in venture history by backing Alibaba in its absolute infancy. But what happens when that visionary decides to scale up? And not just a little bit, but to a level that the financial world had literally never seen before. Okay, let's dive into this. $100 billion. Let that number just sink in for a second. This wasn't just a large fund. It was a complete anomaly. It fundamentally distorted the entire global venture capital ecosystem. Just to put that into perspective for you, that $100 billion was actually larger than all venture capital funding raised in the entire United States in 2017, combined. It's crazy. It basically forced every other major player out there to scramble and raise these massive mega funds just to stay relevant. But with that staggering historical amount of money comes this crushing, almost unmanageable weight of responsibility. Because suddenly you aren't just, picking winners anymore. Your capital is so massive that it physically reshakes the global economy. But here's the catch. What if alongside that absolute mountain of cash, you had zero certainty about the future? See, traditional venture capital usually mitigates unpredictability by spreading relatively small bets across dozens or even hundreds of early-stage companies, right? Because they know most of them are going to fail. But SoftBank, they took the exact opposite approach. They decided to drop these massive, highly concentrated financial bombs into completely uncharted territories. And that, right there, is the ultimate antagonist in our story. Complete, unrelenting unpredictability. So how exactly do you deploy $100 billion when tomorrow is just a total blank slate? Which brings us to Section 1, the $100 billion dilemma, betting on tech disruption. Now, what's really interesting about this slide is seeing how SoftBank actually operated in the face of this massive unknown. You really have to look at their foundational philosophy. They weren't just throwing darts at a board, hoping something would stick. They operated on one absolute unshakable core belief. The future belongs entirely to technology-driven disruption. If a company wasn't tech, and if it wasn't disruptive, SoftBank simply didn't care. Their focus was clearly divided, and they poured unprecedented capital into three main areas. First up, cutting-edge startups with massive, though totally unproven, potential. Second, artificial intelligence companies, and remember, they were placing massive bets way before AI became the daily headline it is today. And third, platform-based businesses that were literally designed to monopolize an entire industry. They didn't just want to participate in a market, they wanted to buy the market itself. A great example of this, they tried to corner the global ride-sharing market by simultaneously pumping billions into Uber, Didi, and Grab. Moving on to Section 2, the aggressive master plan. Invest early, invest big, dominate. And this brilliantly illustrates their strategy because SoftBank did not play nice. Their entire approach was inherently, intentionally aggressive. The goal here was to completely crush the competition, not necessarily by having a better product right out of the gate, but through sheer, overwhelming financial force. They essentially weaponized capital. It was this three-step engine built entirely on the concept of blitzscaling. Step 1, dump a massive amount of capital into a company to artificially and dramatically accelerate its growth. Step 2, use that hypergrowth to aggressively subsidize customer costs. This effectively starves out all the competition and creates absolute market dominance. And then step 3, once you dominate the space, you flip the switch, raise the prices, and collect massive long-term returns. And for a while, it seemed totally invincible. This blitzscaling playbook, backed by an endless war chest, really appeared to be the ultimate cheat code to replicate the multi-billion-dollar returns of those early Alibaba days. But that takes us to Section 3, the high cost of uncertainty, when high growth meets unpredictability. Because every thriller has a turning point, right? What happens when a strategy built on limitless optimism collides head-on with a volatile, totally unforgiving reality? High-growth investments inherently come packaged with extreme uncertainty. And SoftBank was about to find out exactly how much that uncertainty costs when things go sideways, specifically through three fatal flaws. First off, overvaluation. SoftBank's massive checks actually forced companies to accept higher valuations than the founders even wanted. It set completely impossible growth targets that were totally divorced from actual performance. Second was business model uncertainty. They funneled billions into companies that lacked sustainable revenue streams. We're talking about companies that were brilliant at incinerating cash to acquire users, but terrible at actually turning a profit. And third, total market unpredictability. Economic shifts, sudden regulatory crackdowns, fierce external competition, these were completely out of SoftBank's control, yet entirely capable of derailing their heavily subsidized empires. And then, boom! All three of those massive risks materialized at the exact same time. This brings us to the climax of this financial thriller, the collapse of WeWork's IPO. This is easily the most infamous example of the Vision Fund's strategy hitting a concrete wall at full speed. Think about it. Here you had a commercial real estate company literally masquerading as a revolutionary tech platform. It was famously fueled by a massive check written after a legendary 45-minute meeting between Masayoshi Son and Adam Neumann. Incredible, right? It was propped up by billions in Vision Fund cash, bleeding money every single day to fuel hyper-expansion. But when the public markets finally looked under the hood during the S-1 filing process, the entire illusion shattered practically overnight. WeWork tumbled from a staggering $47 billion private valuation to facing imminent bankruptcy in a matter of weeks. Literally billions of dollars in capital just evaporated. Which leaves us at Section 4, the strategic crossroads, the risk versus reward trade-off. So, the Vision Fund is bleeding from these highly public, dramatic losses. The aura of invincibility? Completely gone. Masayoshi Son and his team were backed into a corner, facing a true dark night of the soul. They were staring down a critical dilemma about the very essence of their investment strategy. Option 1 was to just double down on the aggressive path, right? Accept the massive risk, continue writing these astronomical checks, and chase that market-shaping influence despite the whole WeWork disaster. Option 2, on the other hand, was the conservative route. Lower the risk, aim for more stable returns, but accept severely reduced growth potential. It's a classic, agonizing trade-off, because choosing the conservative route meant quietly admitting that the grand $100 billion thesis was fundamentally flawed from the very start. Here's what happened next. Section 5, a shift to discipline, evolving with market realities. Now, initially, SoftBank leaned pretty heavily toward keeping up the aggression, but the market had spoken, and those losses were simply too steep to ignore. The Vision Fund was forced to pivot. They stepped back from the ledge of unbridled aggression and finally embraced a far more cautious reality. This shift manifested super clearly in the launch of Vision Fund 2. The rules of the game changed entirely. They drastically tightened their investment criteria, writing much smaller checks and conducting far more rigorous due diligence. There were no more blank checks being handed to charismatic founders without clear balance sheets. They actually demanded realistic pathways to actual profitability from day one, and severely reduced their exposure to highly speculative ventures. It just goes to show that even the boldest, most aggressive master plans must ultimately evolve when faced with cold, hard reality. So the crucial point is really the grand lesson of the entire SoftBank saga, which is this: intelligent risk management. Listen, investing under extreme uncertainty is not about trying to avoid risk entirely. That's fundamentally impossible if you want outsized rewards. Instead, it's about managing that risk intelligently, with unyielding discipline. Capital alone does not conquer all. Big bets absolutely can create big winners, for sure. But capital without strict discipline, that's just a much larger explosion when things inevitably go wrong. As we wrap up this explainer, I want to leave you with a lingering question to think about. Knowing the history, the staggering successes, and the catastrophic failures, if you suddenly found yourself in charge of a $100 billion fund tomorrow, what would you do? Would you play it safe with disciplined metrics, or would you bet big and attempt to forcefully shape the future? It's a profound tension that sits right at the beating heart of venture capitalism, because in the high-stakes world of business and innovation, the absolute greatest opportunities will forever arrive holding hands with the absolute greatest uncertainties. Thanks for joining me on this explainer, and keep asking the big questions.